Thanks, Rich. Thank you very much. I really appreciate it, the opportunity to be here. Good afternoon, everybody. Just kind of like we've done the last time in March we got together, also then in April. What I'd like to do is just kind of kick things off a little bit and see if I can get my thing forward. Yeah. And just talk a little bit about our workshops. Basically, Dan and I have been for about the last year and a half doing what we call Launch Your Pre-Harvest Marketing Plan, Winning the Game workshops. They're roughly 4-hour long workshops focusing on 3 common marketing concepts: pricing targets, incremental sales, and decision dates. The thing that takes a little bit longer is that we run through a computer simulation. And so actually allowing us to create sort of a plan, work through that plan in a simulated year, and then kind of take what we learned there and apply it to building a plan for the upcoming season. And we'll be wanting to kind of line up some of those August, September for the wheat. And so we'll hope some folks think about maybe talking to your county extension agent and working with us on that, because we'd love to get out and do those. We're built around a little bit this 15-year seasonal index, because a lot of times we like to look backwards and say, okay, what typically has happened? And if we do that on the corn side, we've got wheat harvest there in October, but you look at that seasonal index, and this is the 2007 to 2021 seasonal index, highs and lows starting in January. So start January 1. And basically what it tells us is there's some pretty good pricing opportunities there in that May, June, July period. And so we usually start that out as kind of the base part of our plan. And so, this past year, as we were working with people, this kind of was a base plan we might have been looking at. At that time, we were starting our plan making sales at 550 because December futures were under that come January. They didn't hit that until just shortly early in January. It got past 550. So our plan looked like this, and we kind of had that thing stretched out over to $2, hoping that we'd see that kind of a run up in prices. Obviously, this year was different, but the key things on these plans are this: we have pricing increments, we've got pricing targets, and then we've got decision dates that kind of force us into action. And that's what this whole thing centers around. Obviously, this year's been way different, right? We've seen prices take off like crazy. We've got a war in Ukraine. We've got building drought. We've got all kinds of trade issues, supply chain issues, all these things hitting us at once. And so, part of that whole plan in creating a marketing plan, a pre-harvest plan is there are times you need to make adjustments. And as we talked about last April, we said, hey, keep it simple, right? Focus on those things that you can control. Keep your lenders informed. Work with your broker, your market consultant, whoever, as you start placing positions. And in a year like this, where this market is A, very, very unpredictable, and 2, just skyrocketing, slow down this pre-harvest marketing. And one of the things that we did, and we talked about that, and we'll talk about it again a little bit today, is adjusting your pricing targets. That's one thing you can do. And for anyone who's got themselves put in a bad spot, for example, if you would have been following our plan, the plan I had there, we would have been making sales there about the 4th of January. At like $5.56. Well, right now, with December futures way higher than that, your futures position isn't very good. You've incurred some marketing, some margin calls. And so, what are we going to do about those situations? And one thing we can do is, if we want to get off that roller coaster of that run up, you can always swap out futures and maybe put instead a forward contract. And I just run through real quickly here an example. We did these back in April. I just want to reiterate that, because maybe not everybody's the same group that we've had on then. But one of the things, if you're sitting here and you're incurring some major margin calls, and you feel like, you look at the charts today, it's bouncing up again, and we haven't even hit the primary growing season. We could see more. If you want to get off that roller coaster, one of the things you can do is swap out that futures position and maybe put in place a forward contract. Now, so on the left there, I've got Garden City corn. January 4th, our plan would have kicked in at 556. We would have sold December futures at 556. At that time, we thought basis in Garden City would be, using the averages, 2 cents under. So we were looking at an expected net hedging price of 553. Now, as we did our workshops last winter, the highest price that we had any member or any farmer tell us they thought their price of production would be was about 550. So at 553, we're 50 cents over that. Let's log some sales. So let's say I sell that. Well, okay, April 8th, where were we at? December corn was 716. That meant our futures position was down $1.60. Keep in mind then, every dollar is $5,000 in margin call for a full-size contract. So, that was a pretty significant margin call. A person might at that time think about trying to get out. On the wheat side, if you were doing the same thing, saying, hey, back in November, you sold July 22 wheat at say 776, because that's what it closed on November 5th. You would have been $3.34 underwater on that thing. And that obviously is a bad position. But again, the thing to keep in mind, we hedged at 762, which is well above your cost of production. And so you need to always keep in mind, why did I make that hedge in the first place? And if I made that hedge and it was profitable, one thing you can do is stay the course, because every dollar you're losing in your margin account, you're gaining in the cash side. It's a hedge, and you are going to be netting that price you thought, that 766, that 553. Or nearly there, given whatever basis turns out to be. So, keep in mind it wasn't a bad hedge, even though you are incurring some margin calls. But if we did want to go ahead and swap that thing out, here was the example we ran April 8th. We sold futures at 556. Let's buy it back at 716. We're out $1.61, throwing that penny for our hedge costs. Let's immediately replace that with a forward cash contract in Garden City. Forward cash contracts on April 8th. They were doing that at 746. My net position now would have been 585, 85 cents over my cost of production. And actually about 30 cents better than I thought I was going to be back in January when I did that. Why? Well, when I initiated that hedge, we thought using historical basis, we'd be 2 cents under. Turns out at that point when I could forward contract, basis was actually 30 cents over in Garden City. So by doing this, I'm actually better than where I thought I was going to be. On the wheat side, it doesn't turn out quite so well. Let me turn that video off so I can see my whole page. Then we're looking at a situation of I'm down 335. I take that loss. I replace that with a forward cash contract at 1080. Now my net position is 745. I'd still argue for most producers, that's going to be above your cost of production unless you're just totally droughted out. But again, that's why we have crop insurance. Again, my expected net hedge was 762. Now I'm standing at 745. Why? Well, I thought my basis was going to be 13 cents under. At that time, got to move forward, it's 30-cent basis. We've seen basis really weaken a lot. Now it has kind of come back. Initially, when this market took off, some elevators were actually bouncing their new crop bids to September even. Now, pretty much everybody's pulled it back over. They're using July. Basis has gotten a little bit better. Things have settled out a little bit, but still, we're seeing a much wider than expected basis. So where is our position at? If I was going to be implementing our plan, January 4th, we would have taken a 556 position for our first increment. February 11th, we hit the second increment at 590. We were able to get out at 595. On March 4th, we said, okay, let's slow this thing down. So we rolled forward. And when I say that, what I mean is what we did is we jump up and we said, let's not worry about grabbing 630. Let's push that up, and our next target's going to be 670. Well, we hit that March 23rd. So as of April 8th, last time we talked, we were half priced at an average price of 608 December corn. Again, we had some pretty serious margin calls, but we were priced at $1.08 over our expected cost of production. So again, we're not in a bad place. Again, though, because this rapidly moving market, we ramped that up again, pushed everything back up 40 cents. So instead of looking for, I believe it was, let's see here, instead of looking now for in July 15th, looking for 750, we're looking for 790. We priced one more time at 750, and then again, we pushed that up to 790. And so that's what this plan looks like now. We've slowed things down. We've rolled our pricing targets up a little bit. And now our next two increments, we're looking for 790 and 830. So where are we at? We are now 2/3 priced at an average price of $6.44. That's $1.44 over our estimated cost of production. So again, we've got margin calls, but we are marketing and we are pricing at prices above our expected cost of production. So where do we go for wheat? Well, I guess I go one more slide here on corn. I apologize. In the long term, we are nearing historic highs. And today, let's take a look at corn. We're really taking this thing up again. December corn got as high as 766. Last time I looked, it was 761. So we continue to run this thing up. The July is up to 802. So we're still not quite up to those high highs, but we really are at historic highs. And let's see over here. Wiser man than I recently said, like everybody, we get on webinars. He noted that, the longer this goes on, the more the world's going to learn to adapt and live. And at that time in his workshop, he was actually referring to living without Ukrainian wheat. At that time, India was going to be exporting. They've just recently said they're not going to be exporting. They're banning that. So that's why part of the reason we're seeing prices take off today again. But I think his point is well taken. Two things. Number one, highs don't last very long, not near as long historically as our lows do. So let's keep that in mind as we start thinking forward on both our row crop pre-harvest marketing for 2022 and also if we start looking at 2023 wheat. The longer this goes on, the more the world's going to learn to adapt and live. And the fear that we all have as marketers then is that the market, at some point, this thing's going to turn around and say, okay, we're in pretty good shape. Commodity prices, input prices are all going to come down, but the fear for all of us, and I think, is that commodity prices are going to go down faster. And so again, as we start thinking forward, we probably need to be thinking about taking advantage of some of these prices that are out here. So here's my 2 cents on implementing our plans going forward. When we think about corn, grain, sorghum, soybeans, my thoughts are this: stay with the plan. Follow that pre-harvest plan that you have developed. Our plan has us pricing 2 more increments over the next 2 months. And in that last increment's like at $8.30. If I can price corn at that, that's a pretty good price. I think we should be pretty happy. If you have no plan and you have priced 0 production so far, I would really, really encourage you to take a look at these prices. Call your elevator, find out what forward contract bids are, and ask yourself, do you really want to be continuing to pass on these current prices? At some point, the world's going to learn to live and adapt. And then given your perception of upside potential, obviously think about market minimum price tools as something to bring in here. And let me show you a quick example of that. I got an example here. Let's say we're looking at clay center corn. Our 3-year average is 33 cents under for basis. Our 5 years, 42 cents. That chart also shows, though, that sometimes clay center can get down there as low as 65 cents under at harvest. So we do have some basis risk there. I've got 3 alternatives kind of laid out. A is just selling futures, but buying a call option. This is a way of a minimum pricing contract, basically, where you're locking in a hedge price, which would be 706 if we use that 42-cent basis. But I'm going to buy a call just in case this thing takes off again and we continue to see these prices move up. I can take advantage of that. Now, this is as of Friday the 13th, which I wanted to grab that good lucky day. The other alternative would be B, and that's just forward cash contracting. And I looked in the web. Clay Center was offering $6.99 for corn. They were using a 50-cent basis. If I would buy that call at 70 cents, my net price then would be a $6.28. The alternative C is just to go out and buy a put option. And that would put you at about a $6.36 price. Again, if you look at those lower numbers, the minimum prices, each of those 3 alternatives would give you a similar price. And again, I'd argue that probably are going to be above your cost of production. So profitable prices. Couple of things to point out. Both A and C, selling futures and buying a call or using that put, you're still going to face that basis risk, right? We could see basis get wider. We could also see it come closer to that 5-year average. B, Forward contracting locks you into delivering to that elevator. So I think we need to be very cautious about how many bushels you want to, commit, given the drought that continues to extend. You want to keep that in mind on how much you really want to get ahead and lock those bushels in, how many bushels you want to have locked in. I'd also argue that the futures and call position probably has a little bit more flexibility because you can lift that futures position and still hang on to the call if you want to. You can kind of flex those things a little bit. Whereas the put, you're either in it or you're out. Again, as we turn our attention to wheat, here's that long-term chart. We again are, I think the nearby is now up over $12. Let's see, real quick. Yeah, July is at $13.52. Last time I looked, we are nearing historic highs. Something to keep in mind is that highs typically don't hang around as long as price lows do. So, if you haven't taken any action, you may want to start looking at that 2023 marketing plan. Pre-harvest, and I'm just going to start at the very beginning on trying to create this pre-harvest marketing plan. First, you want to get a minimum price target, and that's that price that you would make no sales at less than that minimum. So we need to figure out what is a reasonable minimum price. And typically what we would argue in our marketing workshops is start with your cost of production, but focus on your average costs. I'm going to throw out there for today, just for sake of argument, maybe an $8.40 as we look at 2023. That's essentially a 25% increase over the North Central dryland budget for 2022 from K-State. Assuming input costs are going to continue to rise, diesel's going out the roof. So I'm adding 25% of that total cost. Again, get a handle on what your costs of production are going to be, but now's the time to start looking at that. Typically, we wouldn't want to do this early, but at these prices, I think we need to start taking a look. The next thing we want to do is figure out what our maximum price target is. Identify that highest price that we can reasonably expect in this 2022-2023 marketing year. And then together, that minimum and maximum, basically, they can create a bookends that then you make incremental sales in between. So one of the things we like to do in our workshops is we take a look at the 15-year seasonal index. Here's the last 15 years. Now, typically, we like to do these wheat workshops September and August. So we start this thing October 1. Again, we're 4.5 months ahead of that. So what I've got there in the first column is the year. This next column is the October 1 price, the price of January or July wheat futures on the first trading day of October, each of those crop marketing years. And then what we do is we just take a look between then and harvest, how high did July futures get? And so, for example, in 2007, October 1, it was $4.83. The pre-harvest maximum price was $6. It got as high as $6, so for a $1.17 rise. 2008, it was $7.01, got up to $12.78 for $5, an 82% increase. Okay, let's put those in order. 2008 was the biggest year. 2011 was the next best year. But one of the things this kind of shows is that 20% of the time, you're going to see at least a 40% rise or at least a $2 run up. That one year, we did actually see a $5.77 run. So a lot of times, what I like to do is just grab, say, $2 is my high and low. Keep in mind that for this year, we're already at about $11.79. I look at $11.79 is where we are right now on that price or on that contract. So, and I want to keep in mind, if we look at that seasonal index, when those highs come in, typically going to come in there in Jan, Feb, and March. So if I was going to put together a marketing plan, and again, this would just be a tentative one, I got a question mark on it. First, you want to determine the percentage of production or anticipated crop bushels that you want to price, right? So again, of your expected production for 2023, how much do you want to price in the pre-harvest period? It could be 1/3 of that anticipated production. It could be all of it. It could be 75% or the amount that you have insured. You got to make that decision first. Secondly, you want to estimate your cost of production. I'm going to throw out there $8.40. And then you start outlining your pre-harvest plan. And I'm going to toss out there, since we are at these elevated prices, maybe go ahead and grab that $12 futures. And so I'd say, maybe by June 15th, let's grab these prices while they're out there, $12. If I can price for July 2023, that might be a good place to make that first incremental sale. Jump that thing up 50 cents, and maybe by August, do that one. Again, the way we'd implement this is we use those price targets first, fall back to the date targets second. So if I don't hit 12.50 by August 15th, I want to go ahead and price those bushels anyway. And then for the rest of this production, we'll use, again, 50-cent increments going up to $14 for my high, but jumping that thing into that Jan, Feb, and March period of next year. That might be a starting point as you start looking at your 2023 pre-harvest marketing plan. So with that, I'm going to turn this thing over. Okay, again, last thing, you want to talk, I got increments, you want to keep that as part of your plan. You want to have price targets, and you want to have decision dates. If you'd be interested in putting together or working with your county extension agent on one of our marketing workshops, get a hold of that agent and start lining those things up, because we'd love to come out and visit more. With that, I'm going to turn this thing over to Dan. But thanks you, everybody. And
well, we'll go ahead and go forward. I appreciate the chance to speak with you again. I think that as Mark had talked about those that marketing plan, I remember that in most years we're aiming at taking advantage of any seasonality that occurs basically before as we move into June and July, and then maybe into August. This year, Mark, my thoughts are that we're so tight and have such issues to deal with in the longer run that my thought initially was that there's enough support that I wonder if we'll have the same drop in prices heading off into harvest for our fall harvested crops. Any thoughts on that before I go forward?
Basically, yeah. Okay, you're saying we could see a drop in prices from today on in?
I'm wondering if we'll have the same depth. We might have a decline into harvest, but with all that's happening on the world stage and even concerns in our own country, I think there's less likelihood of a sharp drop into harvest than we'd have in most normal years. So a kind of a different pattern of seasonality.
I would most definitely agree. I think there's way too many things that are going to be more bullish on outlook wise, right? The weather, the war, all these things. The one, and I'd love your thoughts on this. The one concern I have would be if we would see China, because I believe, their manufacturing activity is almost like it was back in February and March of 2020. So they are really pulling back. If that would put them into a recession, that could start a rolling effect. And if that starts backing off demand from everyone else because they can't produce, they're not shipping, they're locking everything down, could that cut back usage enough that, and again, I'm not saying we'd have the typical rundown in prices, but could that be the thing that maybe starts and kind of negatively impacting, and definitely the thing that would knock us maybe off of these highs that we're seeing now, especially if our corn crop gets planted and could be basically an average crop.
Well, it certainly could happen. There are those thoughts out there. What's kind of a contrary issue to that is that when you look at what country's been most aggressive in forward buying onto the next marketing year, corn and soybeans, it's China by far and away. So interesting that we do have those fears about the Chinese economy and how that may impel or limit their ability or their desire to come in and buy things. But gosh, so far they're buying a lot. And so anyway, we'll come to that as we go forward. So the key things I want to talk about are grain market factors, situations that we'll be looking at this year, what we anticipate on into 2023. And I think we could stand back and talk about concern over supply demand issues, tight stocks to use, high prices, all in play, causing countries to be more protectionist in terms of their domestic supplies. We're seeing that already with a little bit with India, as in the news right now. So in light of that tightness and all that's done on the markets, Then we do want to touch on corn, sorghum, wheat, soybeans today. Of course, we're dealing with weather issues, and we feel that pretty strongly for all of our crops, especially winter wheat here in Kansas. Take note that this week, the Kansas Wheat Tour will be coming out on, I believe they start, Mark, and you're on that tour. I think tonight they start in Manhattan. Tuesday, they go to Colby. Generally, they'll see some drier, there's a drier area, pretty rough area up in the northwest corner, but then I think on the Wednesday, they'll swing down south and they'll see some what's been reported to be pretty rough looking country for wheat on the way, I think from then Colby swinging over to Wichita. So I think we'd be judicious to be looking for market reports that'll be pretty pessimistic with regard to wheat production prospects this year, and probably more support for market moves. I guess we'll see where we go on that. I would say when you look at that, we try to look at these indices to see where what either long-term or short-term factors are working together to drive the markets. Of course, for short-term, we've had some rain in different places, about an inch or so in parts of Kansas, and a little bit more up into Nebraska, 2 or 3 inches in some of those southeastern areas. But again, dry down southwest corner, and that's what we just talked about in terms of the wheat area. Then there's this area up in the Dakotas. They had a lot of late snow, been keeping people out of the field, delayed planting, so that's been a factor in the spring planted crop markets. And then you do have some excess moisture off into the western to eastern to 3 I states, I guess. Some parts of Illinois, Indiana for sure, Ohio, a fair amount of moisture. When you take a long-term drought view, we've brought enough moisture into the Dakotas that we're not classifying them as a long-term drought situation. So I'm sure they're happy that, although they'd really have the crops planted, but we're still right in the thick of it, and worse in much of Kansas, Oklahoma, Panhandle, Texas, and we've been. You all have been watching the markets the same as I have. We've had a lot of reports of a lot of damage, abandonment in winter wheat. That's happened in Oklahoma and parts of Texas, and probably at risk to happening off into parts of western Kansas also. I just keep watching this area in Iowa, about the same area of Iowa, northern part of it, to the west has been dry for about three years in a row by these indices. So just something that just catches one's attention. And then again, a lot of excess moisture to the east. And we, of course, watch the world situations, and there's the dry conditions we see in the U.S. on up into Canada certainly affected their wheat crops, their spring wheat crops up into there. And again, we have had, and we do now have concerns about moisture in parts of South America. You can sure see, especially some pretty important parts of Brazil for the soybean crop that was affected, and also concerns about second crop corn, and quote, there you see it, dry right now and likelihood to remain dry for a while. Dry up in parts of Europe, that again, France, Germany, those areas in particular, we're getting reports that they have concerns. With all of this, if anything, excess moisture in China causing problems, and dry in parts of Australia, pretty wet to the east, pretty dry to the west. Let's take a look at corn and sorghum markets. We'll try to, in the time we have, hit on high points. I think you had received this handout, this PowerPoint presentation, prior to us getting online here. So in the interest of time, I'm not going to show everything on here, but in particular, look at the basis numbers. I've got basis figures for Salina and for Garden City, where it's appropriate for both of them, and especially Salina. And you'll see some variation hopping around. If you want to ask questions about that, we can come back to that later. But of course, the big story in the markets until of late, other than Ukraine, Russia, and that impact on the world market has been the reduction in U.S. corn acres. As you can see, we're down about 4 million acres of corn planted, about that, a little bit less than that on the harvested side. And the USDA came out on Thursday, May the 12th, came out with an updated projection for what they think this year's corn crop will be. And so that they came up with a figure, you see over here, if you can see my cursor, there you go, 14.46 billion bushels. If we would have stated in January that the USDA would be projecting 14.5 billion bushels, that we would have thought that to be extraordinary, because we've generally been plugging in 15 for our expectations, and the top numbers total supplies. Take note that the 14.6 certainly is not that far off of where we've been, like in 2018, 19, 20 crop, but given how demand has grown, especially the world situation, that we're below 15 billion bushels is a quote big thing. And overall, I tried to describe this situation with corn, tightening stocks and stocks to use. The corn yield had been put at 177. The USDA earlier in the year was talking about 181, a record high, but now they've scaled that back to some of these dry and or wet areas, late planted. Production, again, 14.46, and certainly about basically 500 million or so below where we were last year. Ending stocks projecting to 1.36 billion. And it doesn't take long to see where strong use on the export side, any threat to the crop could take that down even lower. So even with the situation we have this early on, moisture in some areas, planning going forward, we're already scaling back expectations for ending stocks for corn. Stocks to use shaved down from at this early stage to 9.3%, was about 9.6. And then projecting prices, the USDA on Thursday projected $6.75. They were at $5.90 a year ago. I'm beginning to think that this is one of the better, more valuable things that I can try to contribute, or we can contribute at KSU, is to look at what as things happen like they're happening today in the corn and wheat markets, and we can go and look at what futures prices do over time, what they're representing for a marketing year projection of prices. And so just did this at 11:30 today. I think what you have in your handout was for Friday, but we've been up about 19-20 cents, and it's made some difference, only about 2 or 3 cents on the current marketing year. We were at 5.98 on Friday, I think. Now we're 6.01, but it has just one day's move of about 20 cents reflected in those far distant futures has jumped that up to about 6.60. And so you look at in the current marketing year, the USDA is projecting, futures project 6.01, USDA about 5.90. So they're pretty close. But when you look at in the new crop marketing year, the USDA number 6.75 is actually higher than what the futures are talking about. I think the thing to watch is, I talked about seasonality. Marco wasn't trying to throw you a hand grenade, but when you look at the marketing year for the 2022-23 marketing year, there is a projection still in the futures of prices falling off some in July and August timeframe, and that'd be consistent with the typical seasonal pattern. Now, that's not a lot in these markets. It's 30 cents, and you're still at looking at corn at above $7, or at least 6.80, 6.90 or something. But still, there is some sentiment towards the market falling off once we get the crop growing. If we have adequate moisture, things look decent. The futures even at this time are pretty flat until we get out into June and July of that next year. So just to look at what the charts have been showing, basically we ran up to on Friday, we closed at 781 and a quarter. And these are the lofty heights we've been trading at, had been up to about 825. But so we're clearly, we've accepted that we have a tight supply demand situation. And now we're just arguing over the details at about 30, 40 cents or 70 cents at a move. So we know we have supply demand situation has driven us to high prices. Now we're just volatilely trying to figure out just how to adequately price the thing. I did want to put up here on the ethanol side of things, just to note for Kansas, we have the highest average corn bid in the state of Kansas of anywhere in the Corn Belt. Note that the basis on average is about 42 cents over. And you compare that to Illinois, Indiana, again, pretty wet back in those areas, probably concern about having adequate supplies in the coming year. Also strong prices, but basis levels also positive, but not within 20 cents of where we are in Kansas. So that's a great thing for Kansas corn growers. Probably puts a strain more on the people that are buying corn. Again, livestock feeders here, ethanol plants, to make things go. And you can see on the right-hand side what's been happening on some of the key price factors in the ethanol market. Did want to show this. Generally, we have pretty level to slightly declining ethanol production. We did run up in stocks and then softened off of that as driving started to go forth. So of course we're heading into the Memorial Day weekend. We'll see what that does for gasoline demand. Did want to show you on corn exports doing pretty strong. In the last week, we had numbers for about 59 million bushels actually shipped. Need 51 to meet the USDA's projection. We've got really strong export sales. We're 63% of the way through the marketing year, 35 out of 52 weeks, and we have total sales and shipments equaling about 92% of the way to the USDA's projection. And we also have sales out into the next year. And again, I think about over 50% of those, 51 or 52%, if I remember that chart right, are made up of what China's doing proactively out into that next marketing year. And we're not on pace at the moment to have the strongest export year we've ever had for corn. But when you see the trend there and how the trend for last year, basically 20 and 22 softened, we could very well end up with more exports at the end of this year than we did last year. It looks pretty positive. I did want to show you, so the USDA and the overall market certainly over the last several years been raising up its price projection. There's a 675 for this year. I did want to add in some of our own numbers out of KSU to say, yeah, I know what the USDA said. Let's give them the benefit of the doubt and say there's 50% chance they're right. And that's not a criticism because that's pretty far out. But in putting together some scenarios here, you can see the details of it. Basically, we could have higher yields than what they're projecting if we have a great year. As the moisture out there in different parts of the year, we could end up have stress of lower yields if these issues in the West hold strong. And then as you can see the probability there. In essence, I think there's a possibility of a lot stronger corn exports for that next marketing year than the USDA is talking about. A lot of that's just because of the absence, the vacuum left by Ukraine, the third or the fourth largest corn exporter in the world, not being able to effectively handle its logistics given a war situation. So you put those together, and so in essence, USDA is projected 675. I've got about 40% chance by my own judgment, my own professional judgment, that they could be $1 or more lower, and about a 10% chance that, man, we have great yields and the price moves a lot lower. So this is a pretty optimistic view of where things are going in the corn market. And just wanted to show you on the overall world supply demand numbers. So these numbers are already by this May report, the USDA is scaling back its contribution from Ukraine out into the world market. And so you see that we're going sideways, basically, on ending stocks. The usage numbers shaved off a little bit. This is overall world supply demand. And the thing to remember about these numbers is when you look at the 22-23 market year, it's counting what they're assuming to be probably a tremendous corn crop in South America to be harvested in the first 6 or so months of 2023. So there's a great crop that they're assuming in there. Even with that crop assumed, they're showing sideways to tight ending stocks. So that's a projection that they're thinking that for that next marketing year that Ukraine's not going to come back quickly. We've been taking this view given our difficulty of estimating Chinese grain stocks for corn, for wheat, for other commodities. And if you take a world less China view, we've been pretty flat in world markets for a good while. And with that, so if you have flat stocks and generally growing usage, you end up with kind of where we're at, inflating prices because things are getting tighter. If you take the world less China, and if you took Ukraine completely out of the situation, say, yeah, I know what's going on. We're hopeful that they're going to be able to get a crop, but if they don't get anything, then you take Ukraine out of the picture, and then you end up with a situation where we're tight, ending stocks declining even further, and just ending up with really no quick relief in sight unless we happen to get tremendous crops in the United States, in Brazil, great crop in Argentina. Where else do we go, really, if Ukraine's out of the picture? I did want to look at grain sorghum real quick. Note the current projection using now this was as of Friday, so you probably the current numbers probably pretty much unchanged, maybe up 2 or 3 cents, projecting a price about 637. Then you look at the the sorghum projected price for that next market year, about 699, and the USDA's come in and projected lower than both of those numbers. So it's fair to ask, well, how do you calculate that? Well, basically taking the same futures numbers as corn and then using the most recent basis numbers and taking that forward. So really pretty optimistic pricing scenarios for sorghum, and not trying to manipulate the numbers. That's just how the numbers work out. Just show you quickly, a little bit lower acres for grain sorghum, but still higher than 2019 and 20. And if there's anything that's kind of a quiet surprise, it's that, grain sorghum exports have been doing decent. There's 10.7 million bushels of exports. You need about 6.6 to meet the USDA's projection. And, you've got sales and total sales for this marketing year, 269 million bushels, 86% of the USDA's projection, about 310 million bushels. And, we're 67% of the way through the marketing year. And note the trajectory of grain sorghum exports. I'm really going to be curious to watch how, as the world is so tight on ending stocks of all these feed grains, what we're going to be, how grain sorghum will end up this marketing year. Very, very likely in a lot of these years, you can see, well, it's tended to fall off. Well, we're hitting at an upward trend that could be pretty strong for sorghum. So it just bears watching. And I just put this together. For sorghum operates within the feed grain markets. And so I'm just generally pretty optimistic for where sorghum prices could go, especially on the export side. Let's take a look at wheat in the time we have left, wheat and soybeans. So you can see the wheat acreage generally. We've had some planted acres move to the higher side, but note the abandonment. And this is a national number That's 78.4% harvested of planted acres is since 2010, that's the biggest losses that we've seen. And there are questions as to whether that number is too optimistic, given the dryness in Southwest Kansas, Oklahoma, and Texas, such critical areas for hard red winter wheat production. So it's abandonment. That's a big issue. And you can see that there's kind of an interesting phenomenon. We basically went pretty much a little bit down a little bit, but sideways to slightly lower for production, but the total supplies are trending downward. So we must be, even though we bemoan the situation with wheat, we're whittling down stocks. We're whittling down stocks and have been doing that kind of quietly. And most years, no big deal. Well, now the whole world's tight as all get out for wheat supplies, and we're a little tighter on our stocks. It's interesting to see that phenomenon. So tighter stocks to use yield 46.6 projected by the USDA. I wonder, with all the dry conditions we have, if that will hold up. Production 1.729 billion bushels. That's for the next marketing year, 1.646 from 21. Ending stocks 619, down from 655. Stocks to use 32 or 33, down from 33 or 34. And USDA, with minor changes in stocks to use in the United States, we've jumped the price basically $3. And so this is a world market factor coming in and affecting the US market. And here's that one chart again. Look at current projections, 777, what the futures are saying. 1226 projected by my own futures calculations or KSU calculations. The USDA's projected about 770 for the current market year, but 1075 for that next marketing year starting June 1. So something is going to have to give. Going to be, if anything, that basically the futures markets, and this is with this run up about 60-70 cents that we had today. I think out of Friday's numbers, that number was at about 1160. So it is as it is. You can see the high prices for at least for the July contract mark as we're looking at charts. Contract high set on Friday, 1282, and again, before we started here, we were looking at 1352. So new territory, and again, lots of we have great strong prices, but we've had dragging poor exports, poor shipments. So much so the USDA has been ratcheting back last 2-3 reports what our expectations are. I think the key question for U.S. wheat overall and for hard red is when do problems in these other countries become so egregious, with India not shipping things out, other countries getting protectionist, that we see buyers, even with our high exchange rates, even with our strong cost of shipping, when are things tight enough that they'll come and they'll start to have a strong pace of U.S. wheat exports? That's a fair question, I think. And note, U.S. wheat exports really, we're plowing new territory in the wrong direction in terms of the 2021-22 marketing year, which is almost done. Ending stocks, you can see. So we have poor exports, generally poor exports going on, but we have tightening stocks and prices shoot to the high side. And like I said, it's the world market's imposing its impact upon us. Did want to show us wheat supply demand balance sheet, and USDA projected 1075, and so admittedly, every scenario I put up there is a higher price than what the USDA has. If anything, I'm probably paying more attention to the futures number, and that was on Friday, 1161. So, I guess if you peel away the cover, you find out that just think that it's going to be pretty difficult in short run without planting crops and having successful production for a period of time to change this wheat market situation, particularly as you've taken such a major player, Ukraine, in essence, out of the market. And so there you can see USDA's projection in the purple there of 1070, and then these other projections, other scenarios, all coming in higher than that. And so here's the world situation, world wheat usage. This is with China all in, reduced Ukraine numbers. You can see how they've been scaling those back. They're still having some hope for Ukraine to ship some grain, but you can see we're at 267 million metric tons ending stocks, 34% stocks to use. We're at an 8-year low. Come in and look at the world minus Ukraine. If you're thinking that you're very worried about their ability to pull a crop out, to ship it out of the country, to be involved in world markets at all, you just take them out, then you can see you're crunching back ending stocks more. You're scaling down exports. You're tightening up usage a little bit, and you've cut back. You see the differential, the size of their crop. So I think that some of the reasons we're seeing all this strong upward volatility and concern in the wheat market has to do with these type of impacts. That, yeah, we know what the USDA has said, but to some degree, it still has to be shown that we'll get much out of there at all this year. And it's just a world less China view also. And we got about just a few minutes. Take a look at soybeans. When the prospective plantings numbers came out, we saw large acreage increases for soybeans. In a regular year, that would have been, I'm using a little bit of hyperbole, the death knell for the soybean market. But with what we're seeing, it's been anything but in terms of actual prices. So you can see about 3.8 million acres in the US, more planted as soybeans. Again, the fertilizer issues had a lot to do with that, as well as high prices. You can see the projection now in that purple number on the far right, 4.6 billion bushels, strong record. We hadn't never been to 4.5 before. Now we're jumping to 4.6, almost 4.65. We are getting up to our total supplies are just a little bit above where we were in 18-19 now. So tight growing stocks to use, yields projected on the high side, pretty strong production. Ending stocks 310 million bushels. Tight stocks to use 6.77. That's still up from last year. And oh yes, by the way, we're at $14. So more stocks to use and more stocks, but still, oh yeah, by the way, the price looks like it's about $3.5, almost, yeah, about $3.5 higher. So inflation, worriedness in these markets having a crossover impact onto the soybean side. Again, there you go again. The current, I did not update this today. It was they were only soybean futures are up about 8 or 9 or 10 cents. Not a lot of impact. So it's probably a few cents higher, but not much. USDA's projection at 13.11 for this market year, 13.64, and excuse me. These are the futures-based projections. If anything, the futures-based projections are lower than the USDA's numbers, and it just is what it is. You'd have to look at how they calculated things, but what the futures are saying are a little less optimistic than what the at this point in time than what the USDA just said in May. And in essence, we're trading in a range. We've gotten into above 1550 up to 1750, and we're just bouncing around within that. Soybean exports, kind of a neutral pace, but strong forward purchases. That's probably what's driving the strength in there. So we're again 35 weeks in, 67% of the way, and oh yeah, by the way, forward purchases are 101% of the USDA's projection, which means they'll probably have to raise that. Total sales on in even to the next year, 410 or so million bushels, 19% pre-sold for next year. So worried buyers. Soybean exports, a decent pace. You can see the blue line there. 2020-21 record high year. We're doing okay, but not at that. And just to show you this, we're paying a lot of attention to the co-products. You know, decent movement in soybean meal, but really some pretty strong movement in soybean oil. The sunflower problems in Ukraine, the palm oil issues that they've had in Indonesia, Thailand, all bringing a lot of support into soybean oil exports. So there's USDA's projection, 1440, pretty strong prices. Here's my projections. Looking at, in essence, 3 scenarios out of KSU with either lower exports, higher exports, or lower yields and lower exports. And you can fairly say that you're out there into a new frontier in terms of where tighter stocks, if 6.8% stocks use is giving us 1440, then what does 4 to 4.5 give us? So that's where you get numbers like that. And the world soybean numbers aren't as, on the surface, aren't as, quote, scary, because we're anticipating a big crop coming back next year in South America. But this year, the year we're in, done August 31st, pretty tight. 9-year low in the current year. And you take China out of it, and you've got basically a 15+ year low. So when China has their view of the markets, you bring that in, and you see I guess they view the markets as tight, and they're buying soybeans and corn to reflect their view, even with the questions we have about the growth in their economy. Interesting. Well, thank you for hearing me out on that. I think, okay, I need to stop that share. All right. So I think at this time, Mark and Rich, we turn it back over to you guys and we open it up for questions.
Okay, folks, go ahead if you have anything for Dan or Mark. We don't have anything right now, but we'd be glad to take some time for this.
You know, I with all the supply demand numbers being so tight, but there's just some things that just come at you. Here we're hoping for stability. Really, we're hoping for stability in the wheat market. But it seems you go along, and India was in position to help alleviate some of the problems. Well, they've got a serious drought going on. You've got some hope that Ukraine would be able to produce, but yet their ports are at issue. There's hope that they'll be able to find an alternative route, but you know, challenges upon challenges. It seems that whereas just a few years ago we thought, well, there'll be another crop. It happens. We're not used to seeing shortfalls. Well, now I think our expectations have switched to where we haven't seen a success, something that's moving in a direction to change the situation now for several months. And if anything, I think we're getting that perspective of lack of success in working our way out of this is well, what's behind such tremendous wheat prices and coming over and affecting the soybean and other markets too.
You just had that comment from Michelle. I don't have any other questions. Mark, do you have any other final comments?
Let's see. No, I do not. I don't have any more to add. Tell you what, these are crazy markets. Dan, would you agree that probably, because I mean, you know, when we look at use worldwide on soybeans and some of these things, it almost appears that wheat's probably the most worrisome crop, even though we continue to lower our exports. And from a worldwide standpoint, we're probably seeing the biggest drop in ending stocks there.
Yeah, I want to take that to that and take it back. That perspective, take it back to that quote you had of that one person, you know, that you said, well, eventually we see what these prices are. We learn to function on them, function about it. And so on March the 7th, when the wheat futures jumped so high, then there's in essence kind of a no mas statement, no more. And we saw basis widen, et cetera, it's as if market participants said, no, we are not going to go there. Well, now we've seen some recovery from that one, and the next day on this like the 8th, I think that's when basis dropped so bad. Well, so now we've still had the function, and prices haven't fallen off. The basis has recovered some, but the futures have kept going up. So if when you talk about rationing, I think part of the U.S. wheat export issue is our high prices. People don't want to pay those if they have better options, but we don't have many options. And so if you have mouths to feed, cattle to feed, livestock to feed, et cetera, ethanol plants to run, I think we're grudgingly learning to do what that quote's talking about. We're figuring out on the margin how to function because we have to at these high input prices. What do you think?
I would agree. And again, and see, to me, and then that means then as someone who's trying to market your crop, right? As we all look back and say, okay, so what are my decisions? What do I do with all this information? And again, I'm not even pretending to think it's going to happen here soon. We got to get through this summer, got to get this corn crop planted. But don't you think that at some point it could be, I don't know, this fall, once we start getting better handle on what South America looks like, and we know what we've got here now, what South America may look like, could we see all of a sudden, take some significant amounts off? And again, I don't mean dropping down to $3 corn, but again, dropping off some of these really excellent opportunities that we're seeing. And so to me, again, the point being, we need to be looking at, can I take advantage here over the next 3 months of these astronomically high that we're seeing?
I tell you, you talk about being one global community. Now we're going to be watching planting down South America. Are they going to have fertile? Are they going to get? And they're planting in our fall months, for some of those crops. So we'll be looking at their acreages. Do they have fertilizer, et cetera? So I guess my response back to you is that, yeah, it could drop off, but we're going to be hopscotching. We're not just going to be worried about our own harvest. We're going to be worried about the planting for the South American harvest, because so much is going to be riding on it. That's probably a call for you and I and Rich to stay on top of that and keep providing information, because we're so tight that I don't know that we're going to get out of this until we start producing our way out of it. My thought.
Dan, there are a couple questions that just came in.
One for you, Rich.
I'm going to leave it to you, man.
Okay. Okay. Do you see, this is from Simon Jacques. Do you see basis widening issues again if secondary freight rail continues to trade at huge premium to tariff, or are the cash users as panicked? Are they panicked and or they fight for bids? Mark, I think you may know on this. I don't know how responsive those freight bids are to a lot of they tend to be, gosh, I'm probably getting myself in huge trouble saying this, but they tend to be a policy move by the railroads. And I don't know how much they do respond to market pressures, but boy, they're long-term in nature. And am I thinking correctly?
Well, we definitely are having some issues on the rail side, running behind in the tariff.
Yeah.
I personally, and again, I'm probably getting deeper than I want to get as far as my level of knowledge. I see the biggest thing causing, problems with basis just blowing up is when we see those unexpectedly massive runs up in futures prices. It just runs up faster than what cash can do or what we can handle. But definitely, Simon's point is there, and I'm I don't know about that.
If you go into that handout, you'll see the Salina soybean basis that had been pretty weak and then suddenly jumped tremendously. But then just in the last, this is off our ag manager chart, in the last observation. So I don't want to just speak out of both sides of my mouth on this, but if you look at again, it's in the soybean section, Salina soybean basis happens to be at a location that thankfully provides us with really good data, a Cargill location. Basis jump in essence, it looks like about almost 35, 40 cents in essence in 1 or 2 weeks. So something was happening. I think perhaps it could be related to what Simon's talking about, but whereas the other basis levels generally level and trending here at that location anyway, maybe they're filling trains or something, but boy, basis really jumped, recovered a lot of what it lost. Let's move on to the next one. Could soybean acres go up 1 or 2 million? If we can't plant corn in the wet areas, we haven't put down herbicides or something that's limiting going from expectation of corn to soybeans in the wetter areas. Again, and you saw them in the Dakotas, maybe the Eastern Corn Belt. This is a well established thing that's happened over time, where when we have problems getting corn in, that we push corn acres out the window of insurability or productivity, and they go to soybeans. So I think it could.
I sure agree. I mean, could is a nice, generous word. Yeah, it could. But it could be also the combination of the March 31 prospective plantings is just that. It's prospective. Heck, that number there could have been 500,000 acres off, and more people were intending to plant soybeans to start with. We'll really find out more when we get the June 30 acres report. But even that one, we're going to have to be a little bit careful, because as Dan was touching on, if we see some late switching, it's going to be difficult to get a handle on that even in come June if we keep pushing back the planting. So this could be one of those years where we may see a situation where NASS comes out and says we're going to resurvey in July and come and go out there and actually go do another resurvey and check to see where acres are. Dan, you think that's a possibility given how we're pushing? Today's going to be a big deal, seeing how much of the crop got planted in the last week.
And don't underestimate double cropping. If there was ever an incentive to double crop soybeans behind something, this is it. But the soybean price levels that we're seeing. So and I can't remember the forum that I was at, but or listening to, but just a lot of discussion. I think we were talking about this from an Eastern Kansas perspective, as we're putting together crop budgets, that we don't want to ignore on our KSU crop budgets what the costs are and profitability of double crop soybeans, just given the year that we have. So,
okay, last call, folks. Is there anything? Hey, there is something just came in, Dan.
Okay, John Campbell asks, do you have any statistics on total U.S. planted acres of all kinds of crops? Are conservation and development efforts reducing the total, or are the ups and downs of corn and wheat acreage, et cetera, just switching crops? Yes, we do have those. And it's always a question of whether I can get to it quickly. Where I go is to the annual crop production summary, and I've got the May report, and it doesn't happen to have those total by state, but yeah, they have total acreage, and I guess I would say I need to look at that trend, but we had seen wheat acres had a long-term downtrend, and that had kind of stabilized a little bit. I hope I'm saying that right. We've seen corn come in strong, in some cases taking grain sorghum acres out to the west. Now we're awfully dry now. We'll see if that holds up under dry conditions. Soybeans have been strong, et cetera. So John, I can answer your question, and just a matter of going to my data sources and bringing it back to you. But So yes, we have the sources. I just need to pull the numbers together. But if anything's at an issue, it's probably the growth in corn on dryland acres, and what had been kind of the crowding out of wheat, and maybe now with the high prices, will that slow down?
Hey, Dan, I might just toss in there. I don't think we've seen a forecast for 2022 crops as far as total principal crop acres. But just going over the last 3 years of total, basically 2019 we were at 303 million. 2020 we were at 310. 2021 317. And actually, I think you look back into, we're seeing CRP acres actually been
right.
We've been rolling it out. So, total acres to plant and are probably growing a little bit. And, you've got CRP that takes out, and you've also got prevented planted acres. We could see some of that this year in these drier areas where people can't get. Because, if I've got wheat dying in Southwest Kansas, we're not going to get a whole lot of milo started unless they start getting some rain. Now, again, that's a small drop in the bucket when you think of the big picture, but so the drought's going to impact some of that. But again, we've seen actually principal crop acres over the last over the U.S. actually been increasing, and I'd say largely that's because we've been getting crops planted, and two, we have been lowering CRP acreage and bringing some acres out, and we're going to see that again this year. We've got more acres out than we've gotten enrolled this last sign.
And Mark, there's an intensity of cropland use. We went from wheat fallow to wheat summer crop fallow to wheat summer crop fallow to wheat summer crop. Hey, can we forget the fallow? Just because of the intensity of land costs. Yes, Rich, go ahead.
I just pulled up the Perspective Plantings report from March 31st, and for 2022, the estimate was 317,375,000, so up about 200,000, but essentially the same as 2021. Now that doesn't deal with the prevented planting issues and droughts
right.
and stuff like that, but it is forecast at that time right at the same as what it was for 2021. Well, folks, I'm not seeing anything else. If you have something, you can go ahead and stay on and just pop something to us quick, but I'm going to go ahead and call an end to it for now. And we appreciate you being on, and we'll let you know when we have something else going on. So thanks very much. Mark and Dan, thank you.
Thank you. Thanks for the opportunity.